Let's talk about irrevocable life insurance trusts. I'm Bob DePasquale from Initiate Impact Virtual Family Offices, and did you know that the estate tax exemption is currently at $12.92 million per person? And that's double for a married couple. There are fewer than 1% of estates in America that will be affected by this. However, it's set to change in 2026. In 2018, the highest percentage of estate tax was set at 40%. In 2009, it was 45%. That's quite a bit. There's also 11 states that have a state estate tax. At Initiate Impact, we talk a lot about tax strategies. And so today we're going to talk about irrevocable life insurance trust to help you manage your estate taxes and think about that percentage that might not be included in the inheritance for your beneficiaries. If you own a life insurance policy, you might know that the death benefit is typically tax-free. However, it is part of the estate tax calculation, so it's not completely tax-free. I have 6 things for you to consider when thinking about an irrevocable life insurance trust. The first is if you transfer an existing policy into a trust, it must be there for 3 years before you pass. If it's in there less than 3 years, then the proceeds will be considered part of your estate. The way you avoid this is establish a trust first, then have the trust purchase the insurance. The second thing is that the trust must be irrevocable. You cannot have the ability to revoke the documents, because then you'd be considered an owner. The third thing is gift taxes. There's currently a $17,000 per year per person per beneficiary exemption. And that would count towards your premiums that go into a policy. There may not be an issue if there's multiple beneficiaries here, but if you're paying more than that $17,000 to a policy only benefiting one person, then you're not going to completely avoid gift taxes. Another important thing to consider related to this is that in order for the gift to be considered present and not a future gift, the trustee of the trust must send a notice to all beneficiaries of the transaction that happened. The beneficiary must be given the option to take their share immediately. This is called a crummy provision. Number 4, the trust cannot be dissolved. If something changes, you may consider just canceling the premium payments and letting the policy lapse. The vessel would be empty at death, but you'd avoid other situations. And you may consider this if the estate tax exemption does remain high, or for some reason you don't want to pass those assets on anymore in that fashion. Number 5 is that the trust can be funded or unfunded. Funded meaning you have other assets in there to pay the insurance premiums, or unfunded meaning only the insurance policy is in the trust. Number 6, the trust can also provide asset protection to the grantor. If there's a divorce, a bankruptcy, or other creditors are looking to get your assets, this will protect it because you have no access to them. In conclusion, we don't know where gift tax rates and estate tax rates, or some of the states that actually have an inheritance tax, we don't know exactly where they're going to be in the future. So an ILIT, or an irrevocable life insurance trust, is an option for you to consider. But you want to think about all your options before making a decision, so be sure you consult tax professionals. And estate planners can also help you, and we would love to point you in the right direction here at Initiate Impact Virtual Family Offices. I'm Bob DePasquale, and I wish you a generous rest of your week.